Hello, and welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at a MetaTrader 5 expert advisor called Perimeter Rejection Hedge. This is a pure price action strategy, and it uses no traditional indicators at all. Instead, it reads support and resistance directly from raw price bars and fades rejections at those levels, with a protective breakout hedge built right in. Over the next few minutes, we'll explore how it defines its levels, how it enters and exits each trade, and how the hedge is designed to respond when a level breaks. Let's get started. So what exactly does the Perimeter Rejection Hedge expert advisor do? At its heart, this is a support and resistance strategy that trades the edges of a recent price range. The interesting part is that it relies entirely on price action. There are no moving averages, no relative strength index, no average true range, and no Bollinger Bands anywhere in the logic. Every level and every distance is measured directly from the raw bars on the chart. The strategy builds what it calls a perimeter. The resistance line is simply the highest high of a set number of recent closed bars, and the support line is the lowest low over that same window. Together, these two horizontal lines form a boundary that the market has recently respected. To measure volatility, the strategy averages the high-to-low range of those bars, and it uses that average as a price action unit for sizing its buffers, its stops, and its targets. This expert advisor is designed with liquid foreign exchange majors in mind, such as Euro versus US dollar, typically on the 15-minute or 1-hour time frame, where clean ranges tend to form and breakouts tend to follow through. That said, it reads whatever time frame the chart or backtest is set to, so it adapts to your selection. In terms of style, this is a mean reversion approach with a twist. It looks to fade price back toward the middle of the range when a level is rejected, and then it adds a separate breakout component if that level fails. It may appeal to traders who are studying range behavior, rejection wicks, and the concept of hedging as a risk management idea. As always, remember that this is educational information only. Trading carries real risk, and losses are a normal part of the process. Let's walk through the mechanics step by step. On each new bar, the strategy first rebuilds its perimeter. It looks back over a defined number of closed bars, 20 by default, and records the highest high as resistance and the lowest low as support. It also adds up the high-to-low range of those bars and divides by the count to get an average range. This average becomes the measuring stick for everything that follows. The key bar for a signal is the most recently closed bar, which the code calls the signal bar. Importantly, the support and resistance levels are built from the bars before it, so the rejection is judged against pre-existing structure rather than against the bar itself. Now for the entries. For a short setup, the strategy looks for the signal bar to poke up into resistance. Its high must come within a small buffer of the resistance line. The bar must then close back below resistance, and it must print a dominant upper wick, meaning the wick above the body is at least a set fraction of the bar's full range. When all three conditions line up, sellers have rejected the ceiling, and the strategy signals a short. The long setup is the mirror image. The bar dips into support, closes back above it, and prints a dominant lower wick, showing that buyers rejected the floor. Exits are fixed at entry and sized in those range units. For a short, the stop loss sits just beyond the rejected resistance, at resistance plus a multiple of the average range, while the take profit sits back toward the middle of the range. The long is, again, the mirror. A minimum broker stop distance is always respected. Finally, the hedge. A rejection trade is wrong precisely when the level actually breaks. So if price pushes through the perimeter by a set multiple of the range while a primary trade is live, the strategy opens one opposing position in the breakout direction at a larger volume. Now both legs are open at once. The primary stop caps the fade, while the hedge follows the very move that went against it. Only one hedge is allowed per primary, and both legs carry their own fixed stop and target. Let's look at the actual MetaTrader 5 code on screen, just as it appears in the editor. At the top, we have the input parameters. Lookback sets how many bars build the perimeter and the range unit. Touch buffer multiple controls how close a wick must come to a level to count as a touch. WickRatio is the minimum rejection wick size as a fraction of the bar's range. SL multiple and TP multiple size the stop loss and take profit in range units, and lots sets the primary volume. Now the short block. The strategy checks three things: that the signal bar's high reached resistance within the buffer, that its close finished back below resistance, and that the upper wick is at least the wick ratio times the bar range. When all three are true, it sets the stop just above resistance, sets the target back toward the middle, and calls open leg with an order type of sell. The long block is the mirror. It checks that the bar's low reach support within the buffer, that the close finished back above support, and that the lower wick meets the same ratio. It then places the stop just below support, the target above entry, and calls open leg with an order type of buy. At the bottom, you can see what open leg actually does. If the order type is buy, it calls trade.buy, which executes at the ask. Otherwise, it calls trade.sell, which executes at the bid. Both sides pass in the normalized stop loss and take profit, so every position is protected from the moment it opens. Let's bring this to life with an illustration. On the chart, you can see a recent price range on Euro versus US dollar. The red dashed line near 1.900 is our resistance, the highest high of the lookback window. The green dashed line near 1.0840 is our support, the lowest low. Together, they form the perimeter the market has been respecting. Watch the opening candles. Price drifts down from the upper part of the range, slipping from around 1.088 toward the floor. Each candle steps lower. There's no rejection yet, just price traveling across the range toward support. By the fourth candle, we're pressing right up against that green support line. Now look closely at the fifth candle. This is our signal bar for a long. Price pokes below support, dipping down to around 1.0838, but then it closes back above the line, near 1.0854. Notice the long lower wick hanging beneath the body. That wick is the footprint of buyers stepping in and rejecting the floor. The bar's low came within the buffer of support, the close finished back above support, and the lower wick is large enough relative to the bar's range. All three conditions are satisfied, so on the next bar the strategy signals a long entry, and you can see the buy marker appear right at the support rejection. From here, watch price recover. The sixth and seventh candles push back up into the middle of the range, each one building on the last as the fade plays out. By the eighth candle, price has traveled the full take-profit distance, 2 units of average range above the entry, reaching roughly 1.085. The take-profit marker appears, the long is closed, and the strategy is flat again, having captured the move back toward the middle. Now the market keeps climbing, and this sets up the opposite trade. The ninth candle pushes higher, approaching the red resistance line. Then comes the 10th candle, our signal bar for a short. Price pokes up into resistance, reaching around 1.0909, just above the ceiling, but it closes back below at near 1.0894. See the long upper wick poking above the body? That's sellers defending the ceiling and rejecting the move higher. The bar's high reached into resistance within the buffer, the close finished back below resistance, and the upper wick is large enough relative to the range. The short conditions are met, so on the next bar the strategy signals a short entry, and the sell marker appears right at the resistance rejection. From there, price rolls over. The 11th and 12th candles step down, each printing lower highs and lower lows as the fade back toward the middle unfolds. By the 13th candle, price has covered the take-profit distance, 2 units of average range below the entry, reaching about 1.0860. The take-profit marker appears, the short is closed, and once again the strategy returns to flat. So in this clean example, we've seen both sides of the perimeter work as designed. A rejection at support producing a long back toward the middle, and a rejection at resistance producing a short back toward the middle. Each entry was defined by the same 3 ingredients: a touch of the level, a close back inside the range, and a dominant rejection wick, and each exit was a fixed, pre-measured distance in range units. Of course, real markets are not always this tidy. Sometimes a level does not hold, and price keeps going. That is exactly the scenario the hedge is built for. If price had pushed through the perimeter instead of rejecting, the strategy would have opened an opposing position in the breakout direction to respond to the failed level. Studying both outcomes, the clean rejection and the breakout, is the best way to understand how this approach is meant to behave. That brings us to the end of our deep dive into the Perimeter Rejection Hedge Expert Advisor. We covered how it builds its support and resistance perimeter from raw price action, how it fades rejection wicks at those levels with fixed, range-based stops and targets, and how its breakout hedge is designed to respond when a level fails. Remember, everything here is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. Markets carry real risk, and losses are a normal part of trading. If you found this analysis helpful, please consider liking the video, leaving a comment with the strategy you'd like us to break down next, and subscribing for more MetaTrader 5 strategy analyses. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.